Welcome everyone to video number 6 in a series of videos that cover the basics of stocks investing. In this video, I want to talk about the different types of investors and traders. I will look at investors and traders from a different lens. So I will use 3 criteria: source of information, goal, and risk. And that will give us 4 different types of investors and traders. Have a financial education and want to make a passive income, so only take low risk. Have a financial education and want to be millionaires, so accept high risk. Don't have any education or education in something else and want to make passive income, so they take on low risk. Don't have any education or education in something else and want to be millionaires, so they accept high risk. The financial education could be formal or by practice, and those who have financial background do their own analysis and research, while those who don't have any financial background depend on others to choose stocks, as they listen to CNBC cable TV news, YouTubers, TikTokers, and Reddit. Their choices are as good as the info they hear. The difference between the two is how confident they are in their choices and resistant to the stock price fluctuation. It makes sense that when you have a good reason for entering a specific position, you will avoid losses that comes from panicking as a result of fluctuation. On the other hand, regardless of the financial background, the purpose of buying stocks gives you 2 types of people: those who want to make passive income and others who want to make so much so quickly. The difference between the two is the risk they are willing to take to achieve their goal. High returns are associated with high risks and vice versa. So those who want to make a passive income reduce risk by diversifying their portfolio by buying stocks in different sectors and industries, while others who want to make so much so quickly invest all their portfolio in one or very few positions, hoping that one stock will double or triple in value in a very short time. Regardless of your goal and strategy, I promote that you should always consider the fundamentals and make simple analysis. For sure, the first few times the analysis will be off, but the more you do it, the better it will be. The reason I promote making choices based on the fundamentals and your analysis is that you're actually buying a piece of a business, and you should know how that business is doing. Focusing on the stock price chart alone doesn't tell you anything about the business itself, but it is definitely a helpful tool to know the price fluctuation. Before I end the video, I want to mention the traditional way of categorizing the people who are involved in the stock market, and it is usually based on their focus. In other words, those who just care about the stock price are called traders, and they are willing to buy any stock if they think they can sell it later with a profit, even if that business was unhealthy and is losing money. While others who care about the business itself and the stock price are called investors. You can break down investors and traders as follows. Traders who buy and sell stocks in the same day are called daily traders, while traders who buy and sell stocks within few days or weeks are swing traders. Investors who buy a stock and plan to sell it within a year are short-term investors, while investors who buy a stock and hold it for a few years are called long-term investors. In the next video, I will talk about dividends and dividends yield. If you like this video, please subscribe and hit the like button.